Equifax has a lot of information, way more than me and you have, probably even more than some governments have, because they have all the credit ratings on everybody everywhere. They look at a lot of this metadata, and man, oh man, does it have some really big telling things for us, and not really good news, but also, if you guys follow this channel, not really much of a surprise. Let's get into a representative that actually works at Equifax. I'm going to share a video with you, and you guys can let me know what you think of this.
That move more into consumers that have a mortgage. And some of that we do believe is down to things like payment shocks, as some of those mortgages are coming up for renewal and they're having to take on a higher interest rate, unfortunately.
So, number one, what she's saying is payment shocks coming from mortgages. Of course, when you were on a variable rate and it had a locked rate for 1 year, obviously you were signing on to something that was 1.5% or something like that. A year later, now you are slammed with a 7% mortgage. Your payments go to the moon. And that's what she's talking about, that payment shock. A lot of people who are on variable rates for a long time, they've been slowly going up. I guess that's still as much of a shock, but not all at once. So this going from 1.5% to 7% is like jumping into Antarctic waters, and massive, massive shock. Okay, so let's continue. She has one other point I wanted to bring up to you guys. Let's listen.
When it comes to bankruptcies or delinquencies, what are you seeing on that front?
Well, I mean, when we look at the insolvency side, it's kind of two parts to it. We have the bankruptcies, the full bankruptcies, which have been low and actually quite flat since the start of the pandemic. Consumer proposals, on the other hand, they have been steadily increasing. Those levels are now above pre-pandemic levels. And in particular for Q1, again, we're seeing a bit like delinquency, more of a growth in terms of consumers with a mortgage. And in particular, what we are seeing is a higher percentage of consumers where there is no pre-warning that they are going to go insolvent. They're not missing payments, they just suddenly become insolvent. So a few things for kind of lenders to be looking out for there.
So, you guys, this is the payment shock that she's talking about, and this is going to continue for a long, long time, unfortunately. And you guys know I've been banging that drum for over a year now, telling people do not be buying a property now. There's always a lag effect. If you guys remember me last year, we were telling you it's 18 months. This is very, very well known in the economic circles, 18 months to feel the effect of a rate change. And we continue to have more of them. So we're not really surprised that Canada continues to raise rates and continues to hammer those productive members of society to bang down the economy and push them into a recession, whether they like it or not. Now, this thing, what she's talking about, is very, very, very easy for us to be able to understand where it's coming from. So let's take a look at just a real example, okay? And we want you just to look at it. Let me know what you think, because they're saying this payment shock. So some people, yes, some people had a very, very large payment. Let's say they were in Toronto and they had a $1 million home in 2022 and they had a $3,000 a month payment. That $3,000 a month payment this year is now up to $5,000. So that is a payment shock. Where on earth are they going to come up with that extra money? And how they are doing it, according to Equifax, is they either get a line of credit or they're putting it on credit cards. Me and you know that obviously they can go to the bank of mom and dad, maybe borrow some for some friends, but they also might drive for Uber or something else like that. But at the end of the day, they can't pull any money out of their home because their home value has gone down, down, down as interest rates are going up and their payments are going to the moon. And so how they're dealing with it is they're getting more and more credit cards. So you have to understand, what is she trying to tell you? This is the hard part. What do you do? What do you do? This is a serious question I'm asking you. What would you do? What would I do? I know what we would do. If we were between a wall, we got to feed our family. And she says, all of a sudden, we have no idea where this comes from. They just poof of smoke, just disappear, and everything falls off. This is exactly the way it happens every single time. Let me be clear. Every single time that this has ever happened, that there's an economic problem or even a personal problem, this is what plays out. So you have a credit card, you have a line of credit, and you are borrowing from it to feed your kids, borrowing from it to pay for gas. You borrow, borrow, borrow until one day the musical chairs just stops. You can no longer borrow from your line of credit and put it on something else. You can no longer take money out of a line of credit or any type of credit, borrow from anybody to pay the other bill. This to take from one pocket to put in the other. It doesn't happen anymore. And in one day, the whole house of cards falls down. You could lose your car, your house, your job, all in one shot, which is crazy town, right? Crazy. So what would happen if I had a line of credit up to $50,000, right? If you're at 30 grand, you have some space and now you're like, oh, I got some time. Got a few more months to pay for that. But what happens if your line of credit is at $50,000? That's what I'm going to ask you. There's nothing left on it. What happens if you have a credit card and your credit card is good for 5,000 and you're maxed out at 5,000? You don't have one penny that you can borrow. Once that comes up and that date is due, you are cooked, man. Your goose is cooked. You're finished. And so this is where we're at right now. And this is why I'm worried for a lot of people. Now, Equifax came out with their article. Their article is very, very telling where we are today. If we take a look at this article, increased demand for credit continues and delinquency rates rise. No big surprise here. Everybody is using credit cards and everyone is having struggle. Their word, not mine. So Equifax, this is not clickbaity. This is just straight up facts from them reading metadata from a zillion people, right? And so total consumer debt remains substantial at $2.3 trillion. Remember, this is Canada. We're a small country. This is not like the United States. But the story, if we look at proportions, like per capita, is a very similar story to the United States, that a credit card usage is going to the moon, right? And let's go down. The higher cost of living, of course, and the influx of new consumers entering the credit market has driven credit card balances to rise by 14.5% compared to last year, Q1 of 2022. Bananas, high cost of living. So people are putting it on credit card debt, and they're putting it on credit card debt at 30% interest. What do you think is going to happen? On average, this to me is shocking. Please pay attention to this. On average, consumers are spending 21% more each month on their credit cards. Read this. Average monthly spend per credit card holder has exceeded 2.2K this quarter. I don't know if you guys need to take a second just to like breathe that in. Are we reading this right? The average usage per user per credit card is $2,200 a month. Good Lord. That is crazy. My eyes almost bugged out of my head. I don't know if you're the only one. When I saw that, I'm like, wow, that is a huge jump. Payments are being missed. In Q1, 175,000 more customers missed payments on at least one non-mortgage product, up 19% from the first quarter of last year. We are now starting to see more homeowners struggle as well, especially following mortgage renewals, where payments have risen dramatically. Remember that we just had this from the Bank of Canada that is warning us that we have a 40% raise in prices, average. So that is going to hurt a lot of people, unfortunately. So this is Equifax, right, that is dealing with this. Housing market faces sharp slowdown. I can tell you from the majority of people that we deal with in all of the brokerages and all the agents, they are facing 50 to 70% drop in income. The housing market continues to slow, with new mortgage originations plummeting by 42% compared to last year. Correct. So now imagine you're down 42% less mortgages, in addition to the fact that many properties are down 20, 30, 40%. So compound 42% drop on top of a 40% price reduction, and you're going to get really it per dollars. So this is a mega problem. So if you guys want to do anything for yourselves, please just go to Investopedia. If you go to Investopedia and take a look at what the lag effect is, we can do it together if you would like. This is so important. If we look at the Canadian GDP, look at up to 1 in 5 GDP dollars is for real estate. 13.5% is coming from real estate services, but there's also other services that you can't even count on. So look at the lag effect. And I would say go to Investopedia, but it is very well known how long a response lag is. When they raise the rates, how long does it take for the policy change to be implemented and the economic impact is felt? Well, when they raise the rates, how long does it actually take? And it says right on that website, and I mean, this is in Economics 101. When the Federal Reserve or the Bank of Canada cuts the rates or raise them, either way, it can take 18 months before there's any evidence. Any evidence. So what you're seeing now, you guys, we are in like inning number 2, inning number 3, and the big shoe to drop is going to be commercial real estate. We did a couple videos on that. I encourage you guys to go take a look at that because this is big news for everybody. And whether you think that you own your home cash, congratulations if you do. Whether you think that you're sitting pretty, I'm telling you, it is going to affect you. Please remember back to 2009, 2010, everybody has some stocks somewhere that it's going to be impacted. Everyone has a retirement fund that owns something in a REIT. Maybe you own it as well. And so if you have some of these products, that could drop as well. Remember, this is all a house of cards, like a domino game. When one goes down, it's going to happen somewhere else. Remember, all these things, Silicon Valley Bank very notoriously went under a couple months ago. And when that went under, everyone said, what happens in California doesn't bother me. But the banks in Canada lost $7 billion each. That's a big number. Okay. So they're all interconnected, man. And this is why we even did a video on Canadian banks and how all the Canadian banks just buy each other's shares. It's a very little inbred little community between these guys. It's really, really weird how when one goes down, they're all going to take each other down. So this is why we have to be careful. But this isn't all doom and gloom. We knew this was going to happen. This is why we were saying last spring, don't buy a property. Don't buy a property. I was telling you, sell, sell, sell. The reason we are telling you that is because it's very, very predictable what's going to happen when this shoots down, right? When they raise the rates up, home prices got to come down. This happens every time. But this is the good news. I can't wait to buy properties. There's a lot of people that bought way too many properties and they overextended themselves time and time again over thousands of years. There will always be some people who do that. And then they're going to end up selling for some really good deals. So I can't wait. I'm very, very excited about it. I have been preparing for like a decade for this, so I hope that you have been too. And this is the key that I want to tell you. It's not too late to start getting ready. Remember, it takes that 18 months lag for it. You could start getting your house in order right now and have that emergency fund and opportunity fund available for you today. And I hope that you do because I think that the future is bright. We got a lot of great things that are going to be happening, some very exciting things in the economies that are coming. I love the ideas of artificial intelligence stuff. I'm very excited. So I hope that you are excited too. Keep on following me and I'll teach you how. Hope you have a great day, everybody.